Hello, and welcome to Portfolio Matters, weekly episode number 52, first one of the new year. And it's not calmed down, world markets. I'm afraid it's been another busy week. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith.
Okay, so an eventful week. We had the Fed's minutes published, and the Fed minutes showed that they were concerned about inflation and intending to accelerate rate rises. And that caused a bit of a tantrum in the bond markets. And as a result, there was a sell-off in the stock market and mainly in the NASDAQ and growth stocks, which is exactly what you'd expect. Now, last time there was a taper tantrum, earlier last year, it faded quite quickly and we had a rotation back into growth. Now, that was one of the surprises of last year, persistent inflation and quiescent bond market. Now, will the same happen this year? The other thing that happened was unrest in Kazakhstan, where the government intended to double LPG prices and precipitated a lot of social unrest, and there's clearly existing unhappiness, and this was a precipitating event, and the government has now fallen. There's a new man in charge who has appealed to Russia, and they've sent in troops, and let's see what happens. But companies with assets in Kazakhstan have taken a big hit, and companies that we are interested in, such as Ferroalloy Resources, Step Cement, and Central Asian Metals, their share prices have all taken big hits in the last few days. And if the unrest were to calm down, then you would hope that their share prices recover, and that is something to watch. Further to our review of 2021 events, we discussed the spike in LNG and a possible idea of investing in Cheniere Energy Partners. Now, we've had this from one of our viewers warning us about UK investors investing in US limited partnerships. So he's saying, I bought some seemingly attractive US limited partnerships until I saw my non-UK based broker deducted a whacking 37%. I queried this and got no reply. Essentially, if you are going to buy US limited partnerships, you really need to find out how your broker is going to treat them. And there is a complex tax treatment, which you need to do some research on. They're going to take 37% of the dividends, then it's probably really not worth doing. And thank you to Robert Dagger for sending us that. Okay, we had a big dump of data, loads of PMIs, which I'll run through quite quickly. So Chinese PMIs, not great. Manufacturing PMIs 50.3. I mean, really, 50 is neutral. 50 is the borderline between expansion and contraction, so barely growing. Non-manufacturing PMIs at 52.7, so growing a bit. And so the general is only 52.2. In the EU was very reassuring, really resilient in the face of COVID restrictions. So the manufacturing PMI only dipped slightly from 58.4 to 58 in December. Services dipped more, as you would expect, because restaurants, etc., are being restricted. That debt was down to 53.1, but that's still expansion, quite reassuring under the circumstances. And in the composite was then 53.3. In the US, The market manufacturing PMIs was very reassuring, 57.7, only slightly down on November. Given all the COVID impacts, that's great. Services was great, 57.6, again, only slightly down on November. So it seems that US has really not been impacted that much by Omicron. The composite was 57, down from 57.2, i.e. it hardly changed. Now, the ISM numbers painted a slightly worse picture in that they had the manufacturing PMIs down to 58.7, which is still a great number, but that's a bigger drop from November. But we're interested in their other figures in their survey. So the new orders was 60.4, which is great, still very reassuring, very strong number. Manufacturing prices, so this is the prices paid by manufacturers, took a big drop. It fell to 68.2 from 82.4. That's an enormous drop. And that implies that pricing pressures, input price pressures going into manufacturers are fading. And that number got quite a lot of coverage on Twitter this week. But what didn't get a lot of coverage on Twitter was the fact the non-manufacturing prices paid index didn't change at all. In fact, it went up slightly. So it rose to 82.5 from 82.3, which implies non-manufacturers are continuing to see rises in input prices, and that is not reassuring. Bear in mind that Western economies are mainly services, not manufacturing. Manufacturing is only about 11% of the US economy. Now, there's very reassuring numbers on employment in the US. So the employment number ticked up to 54.2 from 53.3, but job openings declined slightly to 10.52 million. And in the UK, we had manufacturing PMIs 57.9, down slightly from November, but again, rather resilient. The non-manufacturing was 53.6, down from 58.5. So it took a hit. And the services PMI was also 53.6, down from November and in line with expectations.
So the charts we have for you, China NBS manufacturing PMI, the China NBS non-manufacturing PMI, and the China NBS general PMI, EU market manufacturing PMI, EU market services PMI, which doesn't look as if it's that healthy in the as a trend, and the EU market composite PMI, which again is on a bit of a downtrend at the moment. The US market manufacturing PMI coming back from its highs.
Still a very healthy number, though.
Yeah. And the US market services PMI, which seems to be stabilizing at quite a high level. The US market composite PMI.
Yep. So the logistics managers index has been fading, and this is the commentary from Trading Economics, which I'm going to read out. There was a contraction of inventories for downstream retailers, but a rise for upstream firms such as manufacturers, wholesalers, and I'm not sure what that means, 3PLs. Essentially, downstream retailers struggled to find enough capacity to handle consumer demand during the holiday rush, while their upstream vendors labored to store and manage the deluge of inventory that flowed into supply chains throughout 2021. And that is what the picture that we described throughout much of 2021.
US ISM new manufacturing orders, which is looking healthy. And the US ISM manufacturer prices paid index, which Keith commented on, which clearly has dropped significantly.
Reassuring.
but not so the non-manufacturing prices paid index, 85% of the economy. And the employment ISM manufacturing employment index is rising. And the ADP employment change figure.
This is a really good number. Now, this is the December number from mid-month, and it shows a big surge in employment despite Omicron, and that's great. So the US economy seems to be doing just fine. Thank you very much.
And initial jobless claims has leveled out at a low level. And the continuing jobless claims continues to fall. It's still on its downward trend. I don't think you could say that's changed yet. And the UK market manufacturing PMI seems to be stabilising at a reasonably comfortable level.
I'd expect that Brexit, on the 1st of January, full customs controls would come in the UK. Let's see what happens to UK PMIs in the coming months.
Yeah. And the services PMI doesn't actually look that healthy. It's heading quite rapidly down towards 50.
Of course, we've had stronger Omicron controls than the US, for example. So you'd expect some sort of a hit.
Yeah. And then the composite PMI, which basically is mostly services.
Okay, on to Inflation Watch, and we have now all the figures for November, and it paints a picture of high inflation throughout the Western world, though not in Japan. But the recent events are that the US will be tapering and ending QE by the end of March. The UK has ended QE, which ended on the 31st of December. The EU is tapering, and the pandemic emergency purchase program will end in March, although bond purchases will continue as the ECB reinvests money from bonds that mature. So this is the growth of central bank balance sheets, and you'll see that the ECB continues to climb, although the Fed is leveling off. 81% of EU GDP is their equivalent to their bond holdings. Now, when we look at the reasons for a tight labor market, this is from the US, and it shows that more people than expect, that the trend in the trend in retired people has been broken by the pandemic, and more people have retired than previously expected. So these people have left the labor market, hence the labor market is tight, and that is inflationary. Now, this is QE and what we're expecting to happen over the coming 2 years. So the Bank of England peaked in September 21. The Fed is due to peak in June in 2022. The ECB in February 23, and the Bank of Japan, I think that's an optimistic number. I think they'll keep on forever. But essentially, QE is now tapering off everywhere. And if you think that financial markets have been pumped up by loads of monetary stimulus, then that effect is going to start fading. Now, I thought this was a really interesting table. So this shows the change in the wealth of various parts of the US demographic by wealth over the period Q4 2020 to Q3 2021, i.e. when there's a load of pandemic stimulus. And if you look at the bottom 50% here, their net wealth rose by 50%, according to this. So it's real estate wealth went up by 26%, which you might expect because there had been very strong growth in house prices, but there's broad growth in assets, corporate equities, etc. So people are wealthier, and that is very good for demand because the wealth effect.
Not much cash there though, Keith.
That's true. Other assets up 6.6%. Now, liabilities, presumably that means they've paid off liabilities. Now, wage growth in the US, the Goldman Sachs predicting wage growth around 4% next year. But the trends are still climbing. So let's see whether they are too optimistic or pessimistic. But one thing that's definitely going to happen is hopefully the inflationary pressures from supply chain disruption should fade later in the year. And so this is Goldman Sachs's expectations for how inflation will be impacted by the supply chain. And you'll see that starting in actually quite soon in 2022, some of the components turn negative, and that should bring inflation down. And they're saying that from January 2023, that the effect on inflation should actually be negative. But consumer inflation expectations very much follow the data, and they are elevated. So US consumers are expecting 1 year inflation of the best part of 5%, and 5 to 10 year inflation of 3%, rising to 4% in the New York Fed survey. So that's dangerous because we know that workers have pricing power because there are more job openings than there are people looking for work. And if they have high inflation expectations, they're going to demand wage rises. And business inflation expectations are high, and those are standard deviations. So they're the highest they've been in the last 22 years. And when we talk about commodity price inflation, it is spreading. So these are wheat prices, and you'll see that they have surged in the latter half of the year, and that's food inflation coming down the pipe. Now, when we look at the unrest in Kazakhstan, that was caused by fuel price inflation. And in 2011, of course, we had the Arab Spring caused by food price inflation, which will now be feeding through, and let's see what happens. Okay, a brief section on the fiscal theory of the price level. Now, we've had inflation, and monetary theory has struggled to explain inflation because QE pumped the world economy full of money and there was no inflation. And so Milton Friedman, inflation is always a monetary phenomenon. Well, you pump the world full of cash and now it happened. But the fiscal theory of inflation, fiscal theory of the price level, does explain inflation. And it's really simple. What it says is, look at government balances. How's the government going to pay back debt? In order to pay back the debt through interest and principal, it needs to run a surplus. Is it going to run a surplus? If it's not going to run a surplus, then it has no choice but to print money. And that's inflationary. So if the path of government fiscal balance is permanently negative, expect inflation. And this is the expected path of the US fiscal balance. Essentially, huge increase in debt, not going to run a surplus in the foreseeable future. Expect inflation. It's the only way that the US government can get out of its fix, basically.
So you may remember a few weeks ago we covered the Andreas Stellalarson, and he worked for Nordea, and he did some research that suggested that the booster wasn't terribly effective in Israel, and that it might even make the situation of Omicron worse. And the upshot was that he was suspended from Nordea and he went quiet. Presumably he was on gardening leave. And now he's reappeared on Twitter, and he has an alternative forecast for 2022. So what he's saying is the end of COVID will lead to weaker, not stronger GDP growth because stimulus will be withdrawn. In other words, the GDP growth up to now has been a consequence of the COVID stimulus, which I think is a very reasonable assumption. That inflation pressures already peaked, and it's possible that there may even be negative CPI prints by the end of 22 as a result of the weaker economies. So under those circumstances, growth will disappoint, rates will stay low, and the things to be invested in are US dollar bonds and long duration assets, because rates will stay low or fall. And you don't want to be in cyclicals, which is actually the opposite of what many people are saying right now. So in summary, he views the world economy requires permanent government stimulus to grow, and that without it, it will shrink. And we think that's probably not the case, and that the economy will rectify itself once we get over the pandemic, the effects of the pandemic on shutting down economic activity. But I guess, in fact, the jury is out, because there are so many unknowns in this, and there are so many complex factors that we don't know. And maybe the message to take away from this is, don't go all in on one view, one scenario. Try and be aware that there are various possibilities that may play out, including ones that seem unlikely to you. Keith, what do you think?
Well, I always think it's very interesting to look at other people's views, and so hence we're discussing this. But I just think it's too pessimistic. I mean, I really think that consumers, businesses, they've all got money in their pockets that they're going to spend if they're allowed to. And actually, I also think there's a psychological effect that everyone has been cooped up in their homes and unable to go on holiday for a long time now. And as soon as they're allowed, they're going to try and spend the money they've got. And actually, I wonder whether GDP will be stronger than everyone expects just when people get out, because there is, spending money is essentially comes down to individuals trying to do what they want to do. And actually, I think that everyone just wants to get out and enjoy themselves now. So I completely disagree. And I would actually, my portfolio is pretty much the opposite of what he recommends. But Richard is absolutely right. A sensible portfolio would be well diversified. My approach is the opposite. I take concentrated positions. I try and be nimble on my feet. And if it looks like Andreas Stellalarson is going to be right, then you need to do something about it pronto.
So the EU energy crisis. So day ahead electricity prices are still on a parabolic rise. The rise is just extraordinary, isn't it? German power prices, they hit that peak a couple of weeks ago and fell back sharply, but now they seem to be settling down at around about 8 times what they were in April 2020.
Yeah, the thing is, they have come off their peak, but given there's been a huge actually drop in natural gas prices, electricity prices have not come off that much, and they've come off to an extremely elevated level. Now, we know that on the 31st of December, The Germans closed 3 nuclear power stations in the midst of an energy crisis.
And they've substituted that with coal-fired power.
Yeah.
So 8 million tons of European fertilizer capacity is offline due to the natural gas prices, making it uneconomic to produce fertilizer in the EU. And I think that has 2 impacts. One is obviously puts the price up because there's a shortage of production, and secondly, it is bound to feed through into either crop yields or crop prices, or both. And here we see that the rise in fertilizer prices, ammonia has gone up 4-fold. Sulfur, which is also an ingredient of fertilizer, has gone up nearly 6-fold in 2 years, and phosphorus has only doubled, actually, which is really
yeah. I find this really interesting, actually, because we know that the energy prices will really feed through to ammonium nitrate and urea, which are both made using natural gas in vast quantities. But, muriate of potash and diammonium, muriate of potash is mined, as is phosphate rock. So why has that gone through? It's like, it suggests that it's not just energy prices, that there's been a surge in demand as well.
And presumably, if the price of fertilizer goes up, then the potash producers feel they can also raise their prices. So it's probably a combination of factors. And Europe, as we have actually discussed over the last couple of weeks, Europe is looking to put a green label on nuclear. I'm particularly interested in nuclear projects personally. Gas is viewed to be generally the greenest of fossil fuel production because it produces the least CO2 per kilowatt hour. But putting a green label on nuclear power is, I think, is essential, because effectively, if they don't do that, then countries will hold off putting in place nuclear power. And nuclear power is the only viable alternative we have for reducing fossil fuel consumption for power generation.
Yes, this would be very sensible. Let's see whether they do it.
Too sensible, perhaps.
Well, exactly.
So this is interesting. Russian gas production hit a new record last year. And where did it go?
Also, there was this chart in the FT, and previously I'd been wondering whether they're just sending it to China. But actually, you can see the gas network really doesn't allow you to export gas that should have gone to Europe to China.
No. And global SUV sales, which, as we know, are not very economic vehicles to operate, continue to rise. And that is an indication that the consumer is not really buying into the need to run small, economic, low energy consumption vehicles.
Okay. Brief look at supply chains. So this is reassuring. The Baltic Exchange Dry Index, which is an index of shipping costs, has fallen quite sharply from its peak. But air freight prices continue to rise. Now, this is quite a bad chart from the New York Fed because it's a year-on-year growth. But basically, it rose incredibly strongly during 2021 and has continued to rise in it rose very strongly in 2020 and has continued to rise in 2021. So it's not coming down, it's continuing to rise. But delivery times are extremely high and are not coming down, and backlogs have eased slightly, but purchase stocks are still rising. And all that adds up to very strong supply chain pressures, which are not coming down. So the New York Fed's Global Supply Chain Pressure Index is at its high. So that all suggests, sorry.
Okay, I interrupted you, but I was going to say this flies in the face of inflation is transitory because supply chain issues are going to be resolved. And I would also add that China is locking down. It has a zero COVID policy. It's locking whole cities down, apparently without food. And I don't think the global supply chain problems are anywhere near over yet, personally.
Absolutely, but also, Richard, that we know that inflation tends to broaden. So you get these huge inflation spikes in particular sectors, which affect manufacturers and services, and then over time they pass that on. And so you get a broadening of inflation. That's what I expect to happen this year. Okay, moving on to other charts. Well, this is a great chart. So this is actually what I think is the best measure of US employment, because this is income taxes. And you can see it's shooting through the roof. So you're getting a combination of higher employment and income growth feeding through to big rise in taxes. That's great. It's the strongest growth you've had since this chart began, 1997.
Yeah.
And while we're on the jobs report, this is the quits rate, which it continues to rise. And that, again, paints a very reassuring picture of the US employment market, because people quit their job when they've got another one lined up at a higher wage. But Goldman Sachs have marginally downgraded their growth forecast for 2022, although they are still good. So the full year, they're forecasting growth of 3.5% in the US, which is slightly below consensus, but is still a very good number. But going back to Andreas Stellalarsson's point, the fiscal support will continue to decline over the coming years, although it will still be quite strong. And one of the things Andreas Stellalarson was warning about was a rising dollar, which could lead to an emerging markets crisis. And this is an index of emerging market vulnerability, and it highlights a few countries such as Colombia right at the bottom, which are potentially at risk. Now, I was struck by the fact that Turkey, which has had a full-on crisis, does not seem to be very high up on this list, actually. But if you are interested, pause the video, take a look. And junk bond yields are really low. Actually, this is this junk bond spread, and they are showing no concerns whatsoever. Now, going back to electric vehicles, I thought this was really interesting. In December, in the UK, 26% of all new car sales were electric, just pure electric, and then a further 21% were hybrid. So that you're getting on for almost 50% of new cars not being hydrocarbons.
Yeah, it's interesting, Keith. So my personal view is that my car is relatively old. It's a petrol engine, and I won't change it until I buy an electric car. And I won't buy a hybrid. I'll buy an electric car. And there's no, the logic for me is, why would you buy an internal combustion engine? You're going to be penalised throughout, and it's bad for the environment. So I suspect what will happen is that the delivery times for electric vehicles will simply go up and up. The prices will rise because there'll be pricing power. And in countries where the electricity supply is seen to be robust, people will simply buy electric cars. And probably the conversion will be faster than is projected. The issue there, of course, is that the electricity network is not robust. enough to power a fleet, a large fleet of electric vehicles in this country or any other country. And I'm not quite sure how all that will play out.
No, I agree. And we're seeing very high electricity prices in the EU now. And, we're then asking you to convert to electric vehicles, which will add to electricity demand. But also, when we go through all the commodity charts, you'll see that green metals such as cobalt are going through the roof. And electric vehicles are already more expensive than internal combustion engine vehicles. So, Okay, quickly, COVID. So this chart, pause it if you want to examine it, shows in summary that the higher the vaccination rate, the lower the mortality rate per 100,000, per million people. Mortality rate is on the right. Vaccination rate is on the left. But good news. Hopefully, Omicron has peaked in London and the rest of the UK will follow. And then hopefully we may see the end of this.
I see that there are more older people being admitted to hospital now, and hospital admissions are still rising quite significantly. The question is, at what point do they taper off and follow what we hope will be the downward trend in cases from now on?
Yeah. Richard.
Okay, so the equity markets felt like they had an awful week actually to me, but they don't appear to have had that bad a week apart from the Nasdaq. The FTSE All-Share actually had a good week. Stocks were unchanged. S&P 500 down 1.3%, and Nasdaq down 3.4%. And I think Cathie Wood's ARK ETF has been. I was read today it had another $300 million of redemptions either yesterday or last week. I forget which it was, but it's hemorrhaging, and the tech stocks are hemorrhaging interest. Topics almost unchanged. Bitcoin down 6.4%, which was unfortunate from my point of view, because although I don't own any Bitcoin, I do own some Ethereum, and it was down significantly. I'm hanging on in there for the time being. Famous last words. The pound slightly up against the dollar, and the dollar index up, getting on for 1%. And
yeah, the dollar index is something that needs to be watched, actually.
Yeah,
because that rising dollar puts pressure on emerging markets.
Yeah. So there's the S&P, which clearly is not in the bubble. And the market cap of firms at 20 times sales declined. So what we're saying is total market cap of firms that are valued at 20 times or more sales has actually fallen, which means there are fewer firms valued at such high levels, which actually sort of confirms the chart we showed a couple of weeks ago of the number of companies in the Nasdaq that have dropped by very significant amounts over the last 12 months, including our favourite DocuSign, which at that point had dropped 60%.
Well, this data is from the 31st December, so it'll have fallen further from then. But I mean, the analogy is clearly with .com, where, if you bought them at the peak, they basically declined pretty much to zero.
Yeah. And high inflation is generally bad for tech. And I think that doesn't really surprise us, because tech's earnings tend to be very low if they exist at all. And the valuations are based on hope that the turnover will continue to increase dramatically, and at some point in the long distant future they will turn a profit. So clearly high inflation equals high interest rates equals bigger discount rate equals lower price. That's interesting. 38% of the US market is held by households who are weak holders being people who will sell shares fairly readily if there's a problem in the market, or they perceive a problem to be in the market, as opposed to, for example, mutual funds, which will tend to operate more of a buy and hold strategy, which means that the market is potentially quite labile, and an accelerating downtrend could start to feed off itself if this large proportion of weak holders decide they want to get out. And value stocks are outperforming, as Keith says, hurrah. But clearly, except Apple launched a vehicle, said it was going to launch its own vehicle, didn't it? And this has resulted in yet more value being given to Apple by the PE ratio expansion on the expectation that it will presumably take over the car market along with Tesla. I don't know. It's like.
Well, I'm very struck by the fact that, last year we covered the growth expectations for Apple, and they are really poor. It's PE earnings growth is expected to be essentially flat, just tiny, I believe it's 0.8% or something in the next 3 years.
Yes.
But the share price continues to climb. This market is gone ex growth, and the market's valuing it like a growth company. Mystifying.
This is a chart of Ether, which has nicely dropped out of the downward trend lines that I drew, and is heading towards the uptrend line that I drew. And as I say, I am actually hanging in there, but it's not a very comfortable ride. Fortunately, I don't own very much of them. And Bitcoin's doing the same. I mean, if you look at the chart from July to now, it looks like it's about to form the right-hand shoulder of a head and shoulders formation. In which case, the place to get out is at around about 50,000.
Right. I'll take your word for it, mate.
Thank you, Keith.
I'll just get out. Okay, energy commodities, great week for energy commodities if you're long, not if you're a buyer. So oil had a great week, up 6%. Natural gas, Dutch natural gas bounced. We'll show you the chart, up almost 40% on the week. So the EU energy crisis ain't going away soon. Coal rose. So Indonesia have banned coal exports because they're worried about their own supply, and that caused a spike in coal prices. And uranium also had a good week. This is the crude oil chart, WTI. Now, a new feature is that we are going to put on our commodity charts some companies you might wish to consider looking at if you're interested in that particular commodity. We are not going to recommend them in any way. These are just companies that members of our Discord own and like. Now, talking about oil. Now, OPEC have taken a lot of barrels out of the market, and they are adding those barrels back in on this dotted line path. So if you believe that they have all the spare capacity they claim to have, they will finish tapering in October. Now, I don't believe they have all the spare barrels they claim. I think they will have finished tapering before that. And while we talk about this, this is the EIA, the American Energy Intelligence Agency, and it is saying that essentially it thinks that OPEC crude production will plateau during the month, and actually there's only going to increase by about 600,000 barrels, as opposed to this chart here. It seems to imply that OPEC Plus has about 4 million barrels in spare capacity. And if we look at individual OPEC countries, and pause if you are interested in this, but various countries like Angola, the blue line is their allowed production. The black line is their actual production. So they've been allowed to increase production, but they don't have the capacity. It's just continued to decline. Same with Nigeria. Only a few countries like Iraq actually have the spare capacity, that will grow back to previous highs. Now, one interesting chart here is Venezuela has bounced back, and they are saying that they've had a big increase in production in the last 2 months, up from around 650,000 barrels a day to, they claim, 820,000 barrels a day, because Iran has provided some technical help and also some diluents. Reminder, Venezuela's got heavy oil. In order to make it flow, you need diluents, which there have been sanctions on Venezuela. They haven't been able to get hold of any. But third-party figures do not show the increase in crude production that Venezuela are claiming. Now, reminder, next year, all the various government agencies are claiming that the market will move into surplus. So this is actually Platts Global who's saying there's going to be a surplus in Q1 and Q2, although not a big one. The EIA, I think this is, are saying there's going to be a surplus throughout the year. And as a result, they're forecasting oil prices to fall from their current highs. But global oil inventories are still declining. That's the black line, is 2021. And if that continues, oil prices will stay strong. And I'm expecting strong oil prices this year. And if we think about the future, oil and gas discoveries in 2021 were the lowest in decades. Essentially, we are not investing in new capacity. So that is bad long term. It means that you expect, unless the energy transition accelerates incredibly quickly, we're going to be tight. We're going to have tight markets in oil and gas.
But it can't accelerate that quickly, Keith, because there's a constraint on renewables. And even
I completely agree with you.
Even if you go for nuclear power, it's several years before the that comes online.
I completely agree. Now, I think these are amazing charts, actually, maps. So this is the core Bakken area, US shale, and it shows how much of it has already been drilled out. You know, how much spare capacity is left in the core, the most profitable and productive areas of the Bakken. You can see a few areas, but it's largely been drilled out. And this chart shows the performance of US oil and gas companies compared to clean energy companies over the last 2 years, last year actually. And oil and gas companies have gone up. Clean energy companies have been poor. They're down 25%. Okay, on to natural gas. This is Dutch natural gas. It has bounced. We have had a warm period in Europe that is coming to an end. So this is daily temperatures compared to normal in Germany, and you'll see they've been way above normal, over 10 degrees above normal at times in Germany. And this is in the UK, where they've been over 8 degrees higher than normal. But now we're having a cold snap, and that means we've started to burn gas again. So the Christmas period, Europe was consuming much less gas than usual. And actually, we were rebuilding gas stocks, and now we've started drawing those down. Hence, you see gas prices rising again in Europe. Coal rose sharply on the Indonesian export ban. And a reminder, when we talk about the energy transition, just how small renewable energies are as a part of the global energy mix. It's 78% fossil fuels as of 2020. So if we don't invest in continued supply from natural gas and oil and coal, then we're going to run out of energy. finally, uranium. Now, a clarification. In our review of 2022, I was worried about uranium, saying that because of the buying from the Sprott Uranium Trust, that uranium market had been hostage to the sentiments of investors. If investors decided that uranium wasn't going anywhere and sold, then uranium would come back onto the market, depress the uranium price. That is not true. Thank you to Tom Bailey, who pointed out the Uranium Trust is a closed-end vehicle. So if you sell the shares in the Sprott Uranium Trust, basically the share price goes down. The uranium does not go back onto the market. So clarification. A reminder, Germany has shut 3 nuclear power stations into an energy crisis and replaced it with coal.
So this is Asia's going nuclear. I mean, this is one of the graphs, one of the charts that makes one understand why uranium is a good long-term hold. So, number of nuclear reactors currently in construction or preliminary construction stages per region, and look at Asia, 220 proposed nuclear reactors, and 35 under construction, 56 planned. But the other point I think here is interesting. The US is one of the biggest consumers of energy in the world, yet it is hardly considering any additional nuclear power, and Asia is considering a very large amount of it. And it sort of suggests, doesn't it, that at some point in the future, the country that has the energy has the economic power. There's no question about that. And is this going to contribute to Asia's rising economic power if the US messes up its energy policy?
Well, actually, I think the US will be all right because it's got loads of natural resources, the largest oil and gas company producer in the world. Yeah. But I completely take your point about Europe, Richard. I think Europe is absolutely screwing this up. It doesn't. Whenever you read the paper, doesn't like nuclear, doesn't like wind. Read the FT. Yeah. They're all wind turbines are
I have to say
protested by the locals.
I'm with the protesters there because it utterly ruins the landscape and the skyline. And you look out to sea. You should look out to sea and you see nothing. And now you see all these bleeding huge windmills. I mean, it actually just completely ruined the environment. Sorry, I was a hobby horse there.
Well, we need some energy, and banning natural gas and coal and oil, but they're not replacing it with anything.
We need nuclear power.
Well, I completely agree with you, but then you need to get going right now. Stop, moaning about it and start building.
Get on with it.
Power stations.
Yeah. Anyway, moving swiftly on.
Moving on. Okay. Do you want to do this, Richard?
Okay. So aluminium had a very good week, up 4.5%, a great cracking start to the year. Other big movers, the copper down 2.5% and iron ore up 2.5%. And then magnesium, which we've discussed previously, being highly dependent upon large quantities of electricity, up 5%. Generally speaking, it looks as if the bull trend in commodity prices is continuing into 2022.
Aluminium, reminder, Goldman Sachs are forecasting that aluminium market will move into deficit in the coming years, and high energy prices equals high aluminium. Aluminium is climbing again. Cobalt, elevated. Copper, with it trading well within its range, but high. And a reminder, we are committed to the energy transition, and we're going to need a lot of battery metals, copper, lithium, and cobalt. And these charts show mine capacity compared to the red line, which is demand. Chromium's been coming off, iron ore recovering, lithium going ballistic. Magnesium, which again produced via electrolysis process, so as energy prices climb, so it is climbing. Neodymium, very high. Nickel, grinding higher. Tin, astonishing. Just grinds higher. And we've looked into the tin market. Essentially, no new mine capacity has been coming on. There's been disruptions in Myanmar, and the tin market's very tight, and prospects going forward are that there's no prospect of new supply, basically. This is vanadium, which is kind of flat. Okay, on to precious metals.
It was a poor week for precious metals. Apart from rhodium, I have no idea why rhodium went up as it did, but it was a bit of a shocker in comparison to all the other platinum group metals. Gold and silver got particularly hit with the fairly aggressive nature of the Fed minutes saying that interest rates might start to increase sooner, and that tapering will be is likely to be sooner, and that inflation is becoming a problem. So basically, the market's all saying if interest rates go up, then you don't want to be in gold and silver, which I think is completely wrong. Real interest rates are still -6%. There's still a huge amount of money printing and monetary debasement around the world. Personally, I think that gold and silver should be part of one's portfolio, and they're part of mine. And I think there's a lot of volatility in this element of the market. So we have gold, which is still consolidating. It's been doing it for a boringly long period of time, I have to say.
Yeah.
Central banks have been steadily adding to their gold reserves. So although gold is a pet rock, according to Ben Bernanke, and utterly useless, really, according to many central banks, including the Bank of England and Gordon Brown, central banks are buying the stuff. So there's a bit of a don't do as I do as I say there.
Yeah, but I mean, I think this is a vote by central banks in the assets of other central banks, and they'd prefer to hold gold than bonds in US dollars or whatever that their central banks are printing like mad. So don't follow what they say, just follow what they do.
What they do, yeah. So silver also bottom end of its sort of consolidation range. As we know, silver is an industrial metal as well as a precious metal, and demand for silver is projected to increase as the world electrifies. So and rhodium, I mean, the spike, 15% spike they've had this week is small in comparison to those large moves that we have seen. Whether it started with a new move remains to be seen. Hugely volatile, very difficult to invest in other than through Sylvania or Jubilee.
Okay, thank you, Richard. On to rates. Well, it was a fairly dramatic week in the bond markets. And reminder, 2021 saw bond markets remarkably relaxed about rising inflation, and all bond yields are deeply negative. But then the Fed minutes seem to cause a little bond sell-off. And are the bond markets waking up to the danger of inflation? So you saw rises across the yield curve in the UK, and quite large rises. So the 5-year moved from 0.82% last week to the best part of 1%. That's a big rise. And the whole of the yield curve shifted up. Now, in the Eurozone, the periphery bonds also rose, but frankly, they rose less than UK bonds did. So the market is relaxed about the Eurozone bond crisis. This is Greek 10-year, Italian 10 years are rising, but very reasonable. UK 10-year has risen back towards its peak, and that looks like a trend developing. So
I think the problem we have with these interest rates Keith, is that if the interest rate goes from 0.5% to 1%, it doubles, but it's actually only increased by 0.5%. So in that sense, it might be a shock to people who have recently overextended themselves. But if they go from 1% to 2%, it's another doubling. But actually, the consequence to the economy is then enormous. Interest rates have gone up fourfold. And if you look at go back to the Greek chart, for example, interest rates was 1.5%, I think. Interest rates go up to 15%. They've gone up tenfold. So if you're a business, you've got a tenfold increase in your interest expenditure. Never mind if you're the Greek government. So for the economy, these interest rate rises, because low rates have been in place for such a long time, and businesses normalize their cash flows to low interest rates. I think increasing interest rates are extraordinarily dangerous to highly geared businesses.
Well, absolutely. To a highly geared world economy. I mean, total world indebtedness just keeps on rising.
Yeah.
So on that note, we've had, actually, if you think about it in this percentage terms, the UK 10-year has risen from 0.7 to 1.1 in the course of, is that a month?
60% increase.
Yeah. But if you actually have LIBOR-based interest on your loan, it's going up. And the US 10-year has risen really sharply, actually, and that is responsible for the sell-off in technology stocks and technology stocks. You can cut that, Rich. And finally, the seasonality chart. Well, the seasonality chart is back on. It's on good form this week. Had the first couple of days of the year were great, and now the rest of January is going to be pretty rubbish. Richard, how are you? What do you get up to this week?
Thank you, Keith. So I had a relatively poor week, down 1.6%. This was a combination of a bad week for precious metals and crypto, and a good week for coal, oil, and gas. Sadly, ferroalloy was up 15% at one point during the week, and then it dropped 15% yesterday, which is unfortunate. So not a great start for the year for me. And I made one purchase. I have drunk the Portfolio Matters Kool-Aid, and I bought some aluminium not very much of it, in a spread betting account. And wow. I am waiting for this aluminium to double. As Keith constantly says, it's congealed electricity. It's only got one way to go, and it's going up. So this is not advice, by the way. This is me poking fun at myself. But I couldn't resist it. So that's what I've done.
Yeah. We do drink our own Kool-Aid on this podcast.
How about you, Keith? How was your week?
Okay, before we get going, just a quick recap of my 2021 performance. So I was up 9.9%, which I'm actually very happy with, although less happy when I know that the all share returned 14.4% and I actually underperformed by 4.5%. So despite all our work on this podcast relative to the market, I didn't do so great due to the underperformance of energy stocks. Now, this is my long-term performance of my SIP since I started managing it I started managing it mid-2010, but complete years. And the bottom line is I try and avoid losing money. So I've actually only had a couple of small down years, and even small up years just add up. So my approach is very much, if the market looks overvalued, get out. Equities are very dangerous. We've seen, for example, ferroalloy resources, it goes up 15% and there's some unrest in Kazakhstan, it drops immediately. Yeah. So if you don't think that the forward outlook for equities is enough to compensate you for taking the risk, get out. My history of my involvement in the stock market over the last 30 years is that big down drops have been a regular feature, and you want to have cash to buy equities when they're cheap. And that means taking a view and selling them when they're at the top. And there have been periods when I've been out of the market and, making very little from bonds for literally years, and then just waiting for the market to crash so I can buy it. And that has worked. Okay, on to this week. Well, I had a great week.
Well done.
Oil companies shot up. In fact, the biggest ones, BP and Shell, were great. They both had very strong weeks. And I have my biggest holdings by far are in BP and Shell. Okay, well, I had a busy period. So over the last couple of weeks, I have rearranged the portfolio, selling losers and putting more money into what I think will be the big winners for 2022. Now, I hope people have watched our first batch of reviews of the Share Talk videos we did in 2021. In that, I talk about sentiment. And sentiment and gold miners are being squeezed by a gold price that's going nowhere and oil prices which are going through the roof. And gold miners essentially use a lot of energy to crush millions of tons of rock to get out a few ounces of gold. So when I saw that, I decided to sell my sentiment, and I sold it at a loss of 11%, but I also sold all my junior gold miners for decent gain, but a gain would have been much bigger 6 months ago, sadly. I also sold a tiny bit of Royal Dutch Shell because I needed a bit of cash, but also the weighting in the portfolio just keeps growing and I don't want it to get too large. Now, I've only bought Cheniere Energy a couple of weeks ago, but I thought there were better opportunities, and my broking account, I needed US dollars, so I sold it again for a tiny gain, and then I tidied up selling Castillo Copper, which was a cynical and failed speculation of mine. I talk about that in the update. So what did I buy? Well, I bought some Contango holdings. They are developing a coal mine in Zimbabwe, and actually it's under construction and first production is due. And I've added this conviction column. So one of the feedback was where the people wanted to know how much of each of these stocks we had in the portfolio and what we, how strongly we thought about them, what our conviction was. So I put it out of five, basically. So Contango obviously has got huge jurisdiction risk. It's in Zimbabwe, but I've got a little bit of it. Advanced Energy, a really interesting company, and when I get a chance, I'm going to cover them in Share Talk. They are aiming to scavenge abandoned oil fields around the world, and their first field is offshore Timor-Leste, and they are drilling it right now, and they're aiming to recover oil from a field that was abandoned, and they think they have an 85% chance of success there. So obviously it's small and these things can go wrong, but I like it. Conviction 3 out of 10. Now, Hunting has been a disaster last year, down 30% in a rising oil market. It's an oil services company, but I really believe in it and I added more. So buying my losers, not what you're meant to do. James Fisher was my biggest loser last year, total disaster. But I think the shares are ridiculously oversold now, and I bought a bit more. Again, buying my losers. Petrometad, the same. Some viewers may remember that in November, the Investors Chronicle rated Trident Royalties, which we like, a buy, and its share price shot up 15%, and I sold, and I've been waiting for it to drift back off. It drifted back off, so I bought some of it, and I'm intending to buy a bit more over the coming few days. Arrow Exploration Corp is newly listed. Thank you to Luke Oldfield for bringing this to my attention. I know frankly not that much about it, but I've watched a quick video. It looks quite good. And I bought a bit because the share price was shooting up. And finally, Liberty Oilfield Services, I reinvested my US dollars into Liberty Oilfield Services. Basically, oilfield services, I think, are going to have been bombed out this year because of the lack of capex. But at some stage, capex is going to return. So I think that's highly geared to a rising oil price. I'm quickly going through some charts. This is Contango Holdings with the Zimbabwean coal mine, Advanced Energy. They are drilling right now, but the oil share price has been coming off. Don't know why, but I'm optimistic. Hunting, disastrous last year. The share price is finally ticking back up. I'm well down. James Fisher and Son, my biggest loser last year. We cover this in our Share Talk update, batch 2, actually, but it's now ticking back up. I think it's oversold, so I bought some. Petrometad, Trident Royalties. This is the Investor's Chronicle, shooting the price up by 15% in the day. I've sold it, bought back in. Arrow Exploration Corp has literally been listed for 2 months. And Luke sent me an email. I went to have a look at it, and the share price, the email he sent me must have been going the rounds of private investors because the share price shot up. But I managed to get in at 8p, actually. And this is Liberty Oilfield Services. Okay, that's it. Happy New Year, everyone. Let us hope for a prosperous and less volatile year in 2022. Although,
not much hope
on the evidence of the first week,
it's not going to happen, is it?
No, it ain't. So keep watching as we cover events week by week as we move through the year. But that said, Richard and I will be hiking next week, and Stuart Owen will be hosting the podcast on his own. There'll be a shorter podcast that Stuart will do on his own. So in the meantime, thank you very much for watching. Please can you press like and subscribe to the channel, and it is goodbye from Richard Wheater.
And goodbye for Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.